Good evening and welcome to another episode of the Weekly Market Wrap. My name is Daniel Ang, and today is the second weekend for 2025, and we are only 1 week away from Donald Trump's second inauguration on January the 20th, and we are only 48 hours from another important date. Now, remember, just before the year end in 2024, U.S. Secretary of the Treasury Janet Yellen has warned that the U.S. may hit is debt ceiling. So that will be on Tuesday if that is going to be the date. So this week when we are going into the new week, just be aware that on Tuesday there's every likelihood that the US debt ceiling will come into play again, and that would definitely cause market to be a little bit more volatile as we have been seeing over the last couple of weeks. Now, let's get started. Now, before we go into the content proper, let this be known that this presentation is not an offer to buy or sell any kind of securities, be it FX futures or CFDs, and the trading of any kind of margin products to carry risk of loss. So be aware of your own risk tolerance before you attempt to trade any kind of margin financial products. And the opinion that I'm going to share with you are those that belongs to me and has got nothing to do with the sponsor IronFX. And of course, the content of this presentation has not been vetted by any regulatory body. Just be aware of this. And first off the bat, we can see that the Canadian Prime Minister Justin Trudeau has actually offered to resign, but he will be in office until the election somewhere in March. So we will have to wait for the new Prime Minister to come on board, possibly 2 months after Donald Trump is officially inaugurated as the 47th US president. So this would have quite a bit of play here. We all knew that towards the end of last year, Donald Trump actually toyed with the idea of inducting Canada into the United States as the 51st state. Although initially everybody took that as a joke, but it does look like Donald Trump is using this issue to force some kind of concession from Canada. I'm sure this is Trump's vintage negotiation tactics. And of course, Donald Trump has also flouted the idea of buying over Greenland. And of course, Denmark, who is basically overseeing the running of Greenland, will not be in a position to resist, but I'm sure it will be a very interesting play. Now, Greenland, for all we know, is a icy wasteland. Hardly anybody lives there, but beneath the land itself, there are very precious minerals, and I'm sure Donald Trump is looking into those now that China has actually restricted their export of key rare earth minerals. And of course, overhead, we have the airspace above Greenland, which is just south of the Arctic Circle. And we all knew that Russian and Chinese, if they want to actually launch any kind of missile attack, it can come through the Atlantic, through the Arctic. And so I think Donald Trump is also looking at the military angle and not sure how this will play out. And of course, Donald Trump has also flouted the idea of taking over the Panama Canal and paying $1 for it. What a joke. But again, I think these are all negotiation tactic that Donald Trump is famous for. So we will see how this thing play out over the next few months and years throughout his second term as the US president. So again, this will be something that we want to watch. Canada definitely is in a lot of hurt. Internally, they are divided. Externally, they are facing a recession, and all due to the woke culture that we have seen over the Biden administration. Now, the Biden administration have about 8 days more to go before they hand over power, and 8 days can still see some kind of dramatic happening. So we will have to keep our eyes peeled as to the last 8 days of the Biden administration. We do not know what kind of rabbit they will pull out from their head again. So we will have to watch, okay? So the first data that come out this week was the services PMI for China. We can see that the number came in better than expected. Previously was 51.5. Market was expecting 51.7. It came in a lot better at 52.2. So this is actually good news. And this is number for December last month. Okay, so this is suggesting that the services sector in China is still expanding, which is a good news. Okay, we do not want to see any kind of number that actually points southward. So this is the best we have seen in the last 7 months. The best China's services PMI has ever done for the whole of 2024 was actually in May of last year when it was registered at 54. So 52.2 is actually a good number considering that most analysts are looking at the Chinese economy slowing down. Okay. So the next number that came out was inflation numbers. We have Germany, the CPI numbers month over month has actually rebounded very strongly from negative 0.2 to 0.4. This is 0.1% higher than the market expectation. So it is not good news. Of course, the main number to watch will be the harmonized index of consumer prices. And here we have the year-over-year number, which is the chart on the right-hand corner here. We have both the CPI year over year and the harmonized index of consumer prices year over year for the month of December, and both are pointing northward. So we can see that inflation is flaring up again in Germany. So this is definitely not welcome. And we all know Germany is already struggling, and higher prices do not help. Okay, now that Ukraine has actually stopped the shipment of natural gas from Russia through their pipeline. Now that is going to cause even more hurt in the whole of Western Europe. So I'm sure they would have to find alternate energy sources. And currently, the only place they can buy natural gas is the liquefied natural gas from US and Qatar. Okay, so I'm sure the United States is going to demand for their pound of flesh. Okay, so this will definitely show up in consumer prices in the whole of Europe, not only in Germany. Okay, so in the Eurozone, same thing, the inflation rates that we are seeing, the harmonized index month over month, as well as the core, we can see that it has also inched up from negative 0.3 month over month. The headline numbers was negative 0.3, now is positive 0.4, and the core harmonized index, which is taking over the food and energy component, has also seen a major surge from negative 0.6 to positive 0.5. So month over month, you can see that inflation is accelerating quite a fair bit in the whole of Eurozone. When we look at the year-over-year number, we are also seeing a slight increase in the inflation numbers. Of course, the year-over-year number will be more gradual, but the month-over-month is very troublesome because we can see that prices were actually heading down. Okay, now we have a surge back towards the highest we have seen in 4, 6, 7, 8 months. Okay, so this is not a healthy development. So by and large, you can see if Germany is facing higher prices, the whole of Western Europe will definitely see the same. So this is again not a welcome news. Okay. Now on the year-over-year number for the whole of Eurozone, you can see that it has also gradually been nudged higher, although which is within expectation. Previously in November it was 2.2 year-over-year, and now it's at 2.4, whereas the core harmonized index of consumer prices was 2.7 in November. Now it's 2.7. It has been flat, but the one that we will be watching will be the headline numbers, which is the harmonized index of consumer prices year-over-year number. Currently is at 2.4 from a low of 1.7 just 4 months ago. Okay, so definitely we are seeing higher prices in the whole of Eurozone. Then we have the services PMI for United States. Now this is the ISM services PMI. We can see that it is also going higher, which is suggesting that the US economy, at least in the services sector, is doing okay because it's well above the 50 line at the 54.1. Now this is the best we have seen, or rather the third best we have seen over the last 7 months. So this is definitely a welcome news. Also confirming what we already knew, that the US economy is doing relatively okay compared to the other of the G7. Among the G7, the worst performing is definitely UK. So definitely we are seeing a divergence among the G7 economies, with the US doing a lot better compared to the rest of the G7 economies. Okay. And here we have Australia's CPI numbers. CPI numbers again having stabilized at 2.1% for 2 months in September and October. Now is looking up at 2.3. Of course, this is the number for November, so we don't have December number just yet. So this is the year-over-year number. So we definitely are seeing inflations coming back, or at least rebounding from the low in Australia. Again, Australia economy is in recession, so higher prices is definitely not welcome, because if you have higher prices, then the central banks, the Reserve Bank of Australia, will be under pressure to cut rates, which they have not done so far. Somewhere in the first quarter of this year, definitely they would have to fall in line, because their nearest neighbor, which is the New Zealand, the Reserve Bank of New Zealand has been cutting rates 3 times already, and this has not been followed through by Australia. So eventually, it will have to converge, okay, between the central bank's monetary policy of these two closest neighbor. So definitely, we are seeing in the Pacific, we have seen New Zealand definitely in deep recession. Australia is doing no better, and higher prices is definitely not welcome. Okay, because it ties the hand of the central bank in trying to cut rates. Because if they cut rates in the face of slower growth while they are trying to boost economy, they may also cause inflation to flare up all over again if they cut interest rates too soon. Okay, so this is the private sector employment numbers coming up from the States. We had ADP employment change. We can see for 3 months in a row, jobs created in the service sectors in the private sector has actually dipped from 184,000 now to 122,000. Excuse me for the background noise. I'm in the airport right now. So if you occasionally hear the airport announcement, this is where I am right now. So we can see private sector employment has actually increased only by 122,000 in December, while the annual pay was up 4.6% year over year. So we have lower job creation, but we have increase in income, okay, for the average workers in the private sector. So not sure what to make of this number. It is middle of the road. It is not too high, not too low, but it is definitely among the lower of, if you compare the entire 2024 numbers, from as low as 103,000 jobs to 122,000 jobs, which is the last number for December. It is showing that perhaps in the private sector, the job market is slowing down, but we are not seeing that when it comes to non-farm payroll. In fact, we have a blockbuster non-farm payroll last on Friday. Again, we will come to that later on. Now, retail sales in Australia is surprisingly strong. In fact, it is the strongest since January of 2024 at 0.8%. Definitely, this is a relief for the government, okay, because we can see that if retail sales continue to weaken, that is also telling us that the Australian economy is in deep recession. Having a higher retail sales number definitely is suggesting that there are still spending pockets of spending within the Australian economy, and this is definitely a good thing, because we have seen from 0.1 in September, now we have 0.8 for the month of November, and this is definitely a welcome sign. Perhaps when it comes to the December number, we could be challenging the 2024 high at 1.1%. Of course, we will only know it by next month. Okay, so in the meantime, we will take this number for what it is. Australia, the Aussie dollars are actually rebounded somewhat until Friday, when the non-farm payroll was released, when the dollar came back very strongly. Okay, so in the meantime, this is definitely something that we want to watch. Consider that the Australian economy is definitely on the rope. Okay. Now, the trade balance is also a good number. We can see that in terms of external trade, I think all this has been due to the very active reversal of policy for the current government. Okay, we can see that their trade relationship with China has actually been smoothened somewhat. Remember, during the previous administration, Australia has been taking a very hardline policy stand in line with the United States, and this has created China using their trade relationship to actually boycott importing Australia products, including their minerals. Okay, but now the current administration seems to be having a much better trade relationship with China, and this is showing up in their trade balance. $7 billion is a good number, because very similar to what we are seeing in the retail sales, the trade balance has now climbed to the second best as far as the January number is concerned. January at the beginning of 2024 was a very good number, just under 10 billion Aussie dollars. And then since then, it has gone down here all the way down to September low of $4.5 billion. And now it has climbed back up to 7 billion. And this is definitely good progress. And if they can keep the momentum going, and not rock the boat with China, I think this number should improve over time. Okay, I suppose China will find it beneficial to import from Australia because logistically speaking, it is definitely a lot cheaper to import from Australia than to import from Latin America because the freight charges is going to eat into the profit margin. So if you can source from a nearby locality, that will definitely be more welcome. So I think it takes two hands to clap. First, Australia has realized that they are so dependent on China, and if the Chinese continue to ban the imports of Australia's products and services, that will be detrimental to their economic health. So I think at the end of the day, the Australians realize that at the end of the day, it is the economy. Okay, if they do not want to be voted out, they make sure the economy must be chugging along just fine. Okay, so if that means having a more not taking a more confrontational approach to China, and if that can translate into better trade relationship, why not, right? So we can see it in the trade balance. This is possibly what is happening in the latest number for the Australian trade balance. Okay, so we have China CPI, and China is definitely having a different kind of problem. They do not have inflation, they have deflation. So we can see from the last quarter in August of 2024, inflation has been dipping consistently from 0.6 to the current 0.1. So this is moving backwards, and this is a sign of deflation. Now, deflation that I've always mentioned in previous talks is that it's a more difficult problem to resolve because once people decided that if they can postpone their spending to a later date, they may get better prices, and that is actually causing a negative feedback loop. When companies cannot charge high prices for their goods and services, that means to say they are not profitable, and if they're not profitable, they cannot expand their factories, they cannot expand their production. That means there will be lower receipt, lower unemployment, lower employment, and definitely lower tax contribution. So all this is going to be bad. So China is facing a different set of problem, which is deflation, and the CPI numbers here is very evident. Okay, is simply not existing. Okay, so China will have to find a new way to stimulate local consumption, which I think will be the key to watch if you're looking in China. If you have interest in China or have interest exposure in Chinese equity, everybody is waiting for the Chinese government to roll out the bazooka, meaning to say to launch a very stimulus policy to actually refloat the economy. Okay, because I think export right now is a dead end because with Donald Trump coming back again, tariff is going to be a major issue. So export sector is definitely going to slow down dramatically for China. So they would have to ensure there will be internal circulation in terms of internal consumption. So I think that it is something that we can look forward to, where the Chinese government will roll out stimulus packages to refloat the economy. Okay, and this will have implication for not only Chinese equity market, it will also have implication for the Hong Kong equity markets. Now, retail sales in whole of Eurozone is again slowing down again from a very good number of 3% in September. Now we can see that it's coming back down to earth. The last number for November is 1.2%. So we are looking at more than half of what we saw in September. So this is definitely not a good sign. Retail sales is suggesting that the Europeans are not spending. So this is problematic for the Eurozone. Okay. So again, this will have negative implication for the euro. If you are trading currencies, you want to know that the euro has closed very weak this on Friday after a attempt to rally for the whole part, for the best part of this week. Okay. Canada labor report, and this will be the last major numbers coming out for Friday. We can see it on Friday. We have both the US and Canada releasing their labor reports. As far as Canada is concerned, you can see the change in employment has actually been very robust. In fact, it has been the best so far in 2024 at 90,900 jobs being created for the month of December. So this is a very good number because the market was expecting half of what they deliver in November 50,500 jobs. Okay, market was expecting only about 25,000 jobs. So this number at 90.9, okay, 90,000 jobs is definitely something to cheer. It means that the economy may be rebounding because employment has picked up dramatically. Okay, unemployment rate has also dipped, which is also a welcome news. It was raging at 6.8%, among one of the highest in the G7 economies. You can see 6.8% unemployment is definitely pointing to a very severe labor market in Canada, but with the dip and the increase in the dip in the unemployment rate and the increase in the change in employment, definitely maybe we are seeing a turning point here, possibly, okay? But again, 1 month doesn't make a trend. We have to see how the next few months pans out, and we will get confirmation in the next few months, okay? Over in the States, you can see non-farm payroll has actually increased dramatically as well. Previously was 212. Expectation was 160,000 jobs. It came in 256,000 jobs. So this is definitely almost 100,000 jobs more than the market expected. So the market actually should cheer this number. Okay. However, what we saw was that the stock market actually crashed on Friday on the release of this fantastic and very healthy non-farm payroll numbers, because the expectation is that the Federal Reserve now will have no more reason to cut interest rate, at least in the first quarter. So this has negative implications, okay? Unemployment rate has also dipped to 4.1%, suggesting that the labor market is healthy. And if the labor market is healthy, there is no need to stimulate the economy by cutting interest rate, which in turn caused the negative reaction in the equity markets on Friday. We saw all major equity markets actually came off very, very sharply on Friday. And later on, when we go to the chart, we will be able to see it more clearly. Okay, so the hourly earnings has also dipped, okay, both in the month-to-month and year-over-year number. We can see the average hourly earnings of US workers has actually dipped from 0.4% in this November to 0.3 on the month-over-month number. And for the year-over-year number, it has stayed marginally lower, below 4%, as what we saw in November. Current number is at 3.9%, okay? So relatively is a good number, okay? Now, one last number to wrap up the week itself in terms of economic releases. We have the Michigan Consumer Sentiment Index, which is showing a dip, but it is still relatively strong. Beginning in the middle of the year, we can see that the number has been climbing steadily up to the December number of 74. So the latest number is for this month, January of 2025, 73.2. So it started the year not so ideal, but it is still something to cheer, because at the end of the day, the overall trajectory suggests that these U.S. consumers are confident about the economy, and this is definitely something that we can take and to get a gauge of how the U.S. economy is faring. Okay, there's a question here. Let me take this question here. Suman's asking, gonna Fed cut rates within June? Any possibility here? If you look into the Bank of America, shortly after the non-farm payroll release, we have Bank of America revising their expectation of rate cuts. They come out and say that they do not expect a rate cut for the whole of 2025. So again, depending on who you hear from, Morgan Stanley said at most we're going to have 2 cuts, okay? But with the first cut possibly in October. So we are only in January. So people are talking about at least in the first half of this year, we can forget about interest rate cuts. Okay, we should be happy that there will be no rate hikes. So nobody's talking about rate cuts anymore. Okay, so just so that if the Federal Reserve do not hike rates, that will be a blessing in disguise. But rate cut is what market has been expecting, and this was also why stock market has rallied to all-time high in the month of December. Okay, but we can see that it's a bit of a backpedaling ongoing now, especially in tech stocks. Tech stocks that actually suffer the most in terms of the pullbacks we have seen so far in the first week of trading. Okay, so this negative sentiments appears to be likely to accelerate. So for the month of January, for example, in fact, I am thinking from Q1, I think we will probably see lower prices in equity markets, because technically speaking, we do see signs of weaknesses coming ahead. Now, 3 weeks ago, I did point out some technical outlook in terms of reversal pattern that we see on the monthly time frame. So if you remember what I spoke about 2 weeks ago, on the possibility that the market may reverse, I think we are just beginning to see that happening. Now with the non-farm payroll, I think it is likely to accelerate, okay, meaning to say that the negative sentiment may be hanging over the equity markets going forward. Now, in the weeks ahead, we can see that the core activity will still be centered on inflation. Starting off with the United States on Tuesday, we have this PPI, which is the Producer Price Index, expected to dip from 3.4 to 3.2%. And of course, this is not taking into consideration Donald Trump 2.0 is going to result in higher tariff. So eventually this number is going to point northwards. So if there's going to be any southward movements in the producer price index, this could be the last month, okay, for the month of December. Once Donald Trump comes in, his policy will be a lot clearer. Once he actually follow through with his promises to hike tariff across the board, then obviously everything else in terms of the PPI is going to hit northwards. So 3.2 could be the last low number that we see going into 2025. Now, on Wednesday and midweek, we can see the UK also releasing the CPI numbers. No estimates. Previously, for the month of November, we was 0.1 for month over month. Year over year was 2.6. Now, the core CPI for the UK is expected to dip from 3.5% to 3.4%. Then again, we will be followed swiftly on the same day by the US CPI numbers, month over month headline number expecting to dip, okay, remain stable at 0.3%, whereas the core CPI month over month expected to dip from positive 0.3 to negative 0.1. Okay, so this is definitely a good development, and year over year is the number that we want to be watching, and that is suggesting that it should be pointing higher. In the headline CPI numbers year over year, we're expecting it to be higher at 2.8% compared to November number of 2.7%, whereas the core CPI year over year is expected to stay stable at 3.3%. Then on Thursday, we have employment change in Australia, expected to only increase jobs to 10,000 jobs compared to the November number of 35,600 jobs. Unemployment rates expected to also inch up from 3.9% to 4%. Germany harmonized index of consumer prices month over month expected to stay stable at 0.7. The core harmonized index of consumer prices year over year expected to also stay stable at 2.8%. Now, we also have another big number coming out on Thursday, which is the retail sales for the United States. Month over month expected to be lower from 0.7 to 0.5. So this, if the number coming exactly at 0.5, it will not be positive for equity markets. And retail sales control group, no estimates, previous month was 0.4%. And on Friday, we have the first GDP numbers released among the major economy. We have China releasing their Q4 GDP numbers, quarter over quarter, expected to bump a lot higher from 0.9% to 1.7%. So this is decidedly a very, very strong expectation. So if it come in at 1.7%, that means to say year on year, the whole year, the Chinese GDP is likely to stay above 5%. This is the first estimate. Q3 was 4.6%, and if they manage to hit the high end of the estimates, that means to say that whole year, there's a good chance China GDP number for the whole year will be above 5%, which is marginally lower than what they had expected at the beginning of 2024, which they were aiming for 5.5%. So 5.1, considering the condition in which they're operating in, is still a very good number. Industrial production for China year over year for the month of December is likely to stay stable at 5.4%, which is the same as in November. Retail sales in China year over year expected to inch up marginally from 3% to 3.5%. This is very much in line with the services PMI that we saw at the beginning of this past week. Okay, so a higher retail sales is definitely welcome. Then, of course, to wrap up the week, we have UK also releasing retail sales month over month expected to double from 0.2% to 0.4%. So there you have it in terms of the expectation for this upcoming week itself. There is another question by Suman. 1980 type inflation is possible. I think definitely not sure whether it will be 1990 type of inflation because the dynamics are very different. Back in 1980, we don't have major wars in Europe, major wars in the Middle East. So war are by nature inflationary. Then we have tension between US and China. Hopefully, on Trump's return to the White House, hopefully he will manage the relationship with China a lot better. And if it leads to lesser tension, it will be positive and less inflationary. But for now, everybody will be focusing on what he will deliver in terms of tariff. Okay. On the first day of his administration on 20th of January, he would have to deal with the issue of TikTok. Now, TikTok is likely to cease to exist in the United States if nothing is done when the hammer finally falls, will be on January the 19th. So I think Donald Trump has already mentioned that he is going to do something about it because he has benefited materially from his exposure to TikTok because in the election leading to the November election, we can see that Donald Trump actually benefited from exposure to TikTok. So he wants to keep that platform for him to able to reach out to the younger folks. So let's see what he can do. But again, I think Donald Trump will possibly use that as a bargaining chip again. Okay. So whether or not we're going to get a 1980 kind of inflation remains to be seen. But what is sure is that if war is still going to be dominant, the dominant events happening around the world, inflation is highly unlikely to come down, and we have so many flashpoints that can actually cause prices to actually escalate. Now, US is looking internally, they are looking inwards, meaning to say globalization is practically dead, and we have all benefited from globalization. Now there is a decoupling going on, and the global south are actually on the move, on the march, and the extension of BRICS membership is definitely a trend that is showing us that the global structure is changing. So we are definitely living in a transition period right now. The peaceful period that we have seen post World War II now has already been broken, and we will have to live with new reality. And it does look like inflation is going to be part of this the new reality. So going forward, yes, I do believe we are definitely going to live in a inflationary phase over the next few years, not just this year. I think over the next few years, we will definitely see the global economy facing higher prices all over. Okay, so with this out of the line, let me get into the chart itself. Let me know if you can see my chart. If you can, that'd be great. Now, as usual, I will start off with US equity markets. Let's begin with the Dow Jones. Now I'm going to show you first the monthly time frame. This is the monthly time frame, right? So here I put a bit of a remark, reaction high in November, which is exactly what we've seen. We have a high in November, December. There was an attempt to take out the November high, fail, and then close as a piercing line, which I mentioned is a classical two-bar reversal. Okay, once the January month ends below the opening of November, it confirms that this is a reversal. Okay, so right now we are definitely moving towards that because the past week has actually ended quite negatively. Okay, so this is the monthly time frame. Let's take a look at the weekly time frame. Now, weekly time frame has already seen a beginning of what looks like the start of a corrective pattern. So this is not a total reversal just yet. I think this is possibly part of a corrective cycle. So if this corrective cycle end up as a three-wave pattern, all is still good. Okay, but if we do see the next bounce followed by a very sharp drop, that will not be very welcome. Okay, ideally we want to see a three-wave pullback over time, and that means that hopefully market can stabilize somewhere in the first quarter, ideally in March, and then that will be another buying opportunity because I don't believe that a bull market is over by any means. Okay, there's still a possibility that the bull market is very much alive. Okay, this is seen to be a technical pullback in a higher time frame. So with this in mind, just be aware that the current pullback is not calling for a collapse in US equity markets. Okay, so this is part of corrective pattern. Okay, so if we do see higher prices, a bounce followed by another drop, that will be a three-wave pattern. So long as on the daily time frame we do not break below 37,232 in the daily Dow Jones, I think we are good to say that the market is still very much bullish. Okay, so look for buying opportunity, because this could very well be the last buying opportunity before the markets resume its bullish trend. Okay, so having said that, let's take a look at the S&P 500. Same thing. I'll take a look at the monthly time frame. If you remember, I did mention this is not a classical piercing line, but you can see that the closing in December did not even close below 50% of the November trading range. Okay, but by and large, I think the market is not driven by S&P 500. In fact, the S&P 500 is the strongest among the US equity market index. Okay, so if you have to buy, maybe if the dust settle, maybe we can gingerly go back to S&P 500. But right now, it seems that the global fund managers are pulling out of the Dow Jones, and that can be seen in the Dow index itself. So S&P 500 do have what appears to be possibly a reversal pattern, but it is not classical in that sense. So if you look at the weekly time frame, again, we are seeing the same thing, right? The market has a bounce back into this darkened pink color area, which is a very low risk area. If you have actually shorted it, that will be ideal, but the market right now doesn't seem to be telling us that it is going to come down massively just yet. We're going to take a cue from the other index, such as the Nasdaq 100 or the Nasdaq Composite Index. Okay, so again, when we look into the daily time frame, this is what we see. Okay, market is doing possibly a three-wave, but it could be a very complex three-wave in the sense that it could be a double tree or triple tree or some kind of a more complex structure. But for now, we are taking this as a potential corrective pattern. We need to say that you cannot sell. It's not safe to sell just yet, because this may not end up to be decisively lower. Okay, but we just take it as allow this pattern to work itself out. Okay, like I said, I do not expect a meltdown. Okay, if there's going to be more severe pullback, depends on the structure again, but I think by and large we should be able to see some kind of softening of prices going into the first quarter. Okay, so this is not a great start for the year, but it's all about how you're going to close at the end of this year. Okay, let's take a look at the Nasdaq, which is this is the Nasdaq 100, by the way, not the Nasdaq Composite. We can see that this is a classical pattern. The market high was in December. Okay, 22,132.1 was the high traded in the Nasdaq 100. It ended up as a pin bar. And if I take the entire range here, which is 50%, right? The entire range here, the market actually went beyond 50% and then closed as a double pin. If we get a double pin, it's again very bearish development. So if you have to sell, okay, to take advantage of the expected correction in US equity markets, perhaps this will be a good index to do so. Not so much the Dow, not so much the S&P 500, but I think the Nasdaq 100 is a good candidate if you are having a very bearish view, thinking that this may actually lead the market a lot lower compared to, let's say, the Dow or the S&P 500. So this will be a good candidate to watch. Okay, in the daily time frame, let's take a look at the daily time frame. So here we are. Daily time frame appears to be in the cusp of forming a three-wave pattern. Okay, so we already have an initial drop followed by a bounce into the VDR area at 21,848.6, and then now we have the lowest closings since when? Since December the 2nd. Okay, so we have a 1 month low closing on Friday itself, and this is setting the stage for lower prices into this coming new week. Okay, so lower prices can be expected in the Nasdaq 100. Across the Atlantic, we want to see how the FTSE is panning out. Now, FTSE remains in consolidation. This is the monthly time frame. The high traded in the FTSE was actually in May of last year at 8,477.3, and the market has gone into this sideways pattern. No new high were traded, no new low were traded since this low here that we saw here in August. Okay, the low traded here is 7,912.3. So we do not have new high, we do not have new low for at least the last 4 months, okay, 5 months. So again, there is no clear indication what the UK market will do based on this monthly time frame. Okay, so maybe the sign is not there just yet. Okay, but we can see the consolidation a lot clearer in the weekly time frame. So nothing to see here as far as this chart is concerned. So long as the 6,477.3 is not taken out, I think the market will continue to consolidate. Okay, so until one of these markets started to come off very aggressively, then we know for sure that equity markets are in for a more pronounced what you call that correction. So I won't be looking in the FTSE for now. Let's take a look at the DAX to see if there's any kind of uh, thing that we need to look out for. Again, in the DAX, this is the DAX, which is the German index. This development here in December with a new high of 20,526.5 is also end up as a pin bar. Okay, so this is very similar to the setup in the Nasdaq 100. The market attempt to rally this past week itself, not quite making it. The high was 20,485.1. Okay, so it did not manage to take out the December high, but it did not end as a double pin bar, unlike the Nasdaq 100. Okay, so again, nothing to see here just yet, but I suspect the prices here may not be able to take out this high in December at 20,526.5. So on a risk reward basis, I think if you are bearish on the European markets, perhaps the DAX could be something that we can look at. Let's take a look at the weekly time frame to see if there's any confirmation for that. Not. We don't see very clear cut, but there is what I call the spinning top here. Okay, this is a spinning top. Spinning top is also a classical reversal pattern. So the high was actually 20,526.5 in December, end up as a spinning top in the weekly time frame. So like I said, on the risk reward basis, maybe it does make sense to attempt to sell by putting the stop just above this new high here. Okay, so if you want to trade counter trend, this could be a good possible one way to trade. Okay, and then if you look at the daily time frame, it's even clearer. The market has rallied the whole of last week until Wednesday, when the market hit the top of 20,485.1 and end up as a mini pin bar. Okay, so we can see that this area here is definitely an area to consider, because this area here is where the what we call VDR is, which is 20,335.5 to 20,526.5. This area here offers a relatively low risk, high reward trade setup, in my opinion. Okay. Now let's take a look at across the in the Pacific. We look at the Nikkei 225. Now, this is the monthly time frame for the Nikkei. The Nikkei is also in consolidation. We have very heavy resistance above near the 40,000 levels. So for the last 4-5 months, you can see that this area here has been has been met with very strong resistance. So depending on how you look at it, okay, this development here that we saw here in August is my only problem, because the market actually pulled back very strongly from a low of 30,379 to close as a very strong pin bar. Okay, so that actually, technically speaking, should actually give the market that bias to the upside. But over the last 4 months, we can see that the market has been struggling and being kept at 40,000 in the Nikkei 225. So technically it should be a buy, but the fact that the last 4 months has been kept at 40,000 is something that we want to watch. If the market ends up with a very strong flush to the downside, then obviously that will be a sign that the market is exploring the lower end of the range. Okay, so in the weekly time frame, let's take a look at the weekly time frame here. Weekly time frame, you can see that the market here actually struggled. Okay, over the closing of this past week, we can see that this is the lowest closing since December. Okay, so the market is trading at a 1 month low so far. So this could be setting the stage for lower prices into this coming week itself. But again, there's no strong confirmation that this is going to topple over. But from the risk reward perspective, if we sell anywhere between, let's say, 39,900 all the way to 42,500, I think this area highlighted in this dark pink area should be offering us a low risk, high reward trade setup. Now, when we look at Hong Kong, Hong Kong is still struggling. We can see from the monthly time frame, the market end up as a three wave with a high at 23,264. That was at least 4 months back, okay? And the market has been trading lower. In fact, this past week, we can see for the month of January so far, it closes at the weakest point. Okay, so this is suggesting that Hong Kong market is definitely struggling, waiting for some kind of rolling out of stimulus package by China to actually reinvigorate this interest in the Hong Kong market. So by and large, technically speaking, Hong Kong is not where you want to be at least not for now. Okay, the market structure looks like it's still in favor of the longer term bearish downtrend, and the closing this past week has been, especially on Friday, has been relatively weak, suggesting lower prices ahead. Again, but the catchment area could be somewhere between here. Okay, let me see where this area is. The catchment area is at 34,600 all the way to, sorry, 14,600 to 16,300. So if the market do dip into this blue zone here, I think on the risk reward basis, maybe that will be offering some kind of bottom fishing here. Okay, so Hong Kong market is decidedly weak if we want to look at it this way. Now, over in currency markets, let's start off with the euro. Okay. Now, the European market actually started the week actually quite well. Okay, but overall, we can see that this market here is expected to go even lower. I'm caught on the wrong side of this market for now. Hopefully, I can get out without taking a hit here. But I was hoping for a bounce. Okay, but I was buying near this area here. Okay, but that follow through did not come. Okay, so in now, I think there's very good chance I'll be stopped out in this coming week itself. But by and large, you can see the overall trend is down. Okay, especially if the market take out 95 cents. Okay, to the dollar, I think that will cause the entire long-term structure here to topple over. In the weekly time frame, you can see that the market right now is pulling back in a three-way structure. Okay, very little to expect that the prices can hold. I think the momentum suggests that this gradient seems to be steepening, suggesting lower prices just ahead. Okay, and then in the daily time frame, definitely we have no buying signal whatsoever. The market closed actually quite weak on Friday, and this is after the non-farm payroll, which actually accelerate. And at the beginning of the week, there was this rally attempt, okay, but that was totally undone when Friday came. Okay, so on Monday, the market actually was quite strong to the uptick. Okay, the strong move on Monday was actually quite conducive for follow-through buying. But however, ever since Tuesday started, no new high was traded, and the market reversed and steepened the decline going into the non-farm payroll. Okay, so this is where we are. So the dollar is coming back strongly across the board. So if you are holding on to strong long dollar position, I think you are in a good place. However, if you're holding on to short dollar position, you have to consider. Okay. Now this is the sterling. Sterling also closed pretty weak. In fact, we have 4 months of decline ever since we hit a high here last year at 1.3434. The market has been coming down for the 4 months in a row, and end up this past week on a very, very weak closing. So this should actually see some follow through selling in sterling going forward. So this is again confirming what we already saw in the euro dollar, in which the dollar is very, very strong. All other major currency is currently reeling. Okay, so this is not just a dollar strength against one currency, it is across the board. Okay, so Friday closing on the lowest point of the week is testament that if the market goes much lower below 1.18, we will reverse this entire rebound that we see. Okay, so again, depending on how this market close this by this end of this month, okay, if it's below 1.18, I think the rebound that we see in the currencies is over, and the dollar is definitely coming back very, very strongly. What about Aussie dollars? Let's take a look at Aussie dollars. Same thing, Aussie dollars is also closing at very weak levels. So we can see that the overall structure suggests that the long-term bear market in major currencies is resuming. Okay, again, a lot will depend on the low here that we see. Okay, below the 55 cents. This is based on the monthly time frame. Everything is showing us that the dollar is very strong right now. Okay, closing at 61 cents. So I think if it goes way below 55 cents, the bear market in major currency is really across the board. Okay, so just be aware, the dollar is on the march. Let's take a look at dollar yen. Dollar yen do not have a very strong rally. Okay, we did have new high for the month of January. The high traded was 158.88. Okay, and this is very close to the high last year at 162. So there's very good chance that this high may not hold. Okay, if the current trend that we see in the strength of the dollar, it may result in dollar yen going above 162. Now remember, 162 is a key number in which the Japanese authority are definitely eyeballing, because the last time the market came close to 162, they intervened in the currency market, causing the dollar yen to collapse all the way to 139.5. Okay, this is a big move here, and of course, if the market right now is flirting with 162, we want to see if the Japanese authority will come into the market one more time to intervene, because the Japanese cannot afford to have such a weak yen. Okay, because they import most of their energy products, and if a lower Japanese rate will not only result in higher input costs, it will also deter Japanese company operating out of Japan to repatriate their yen. Okay, so this is something that most likely we will see higher prices. Okay, the target right now is about 160, 185. Okay, which is very far away. 185 is the long-term target for the dollar yen rate. Okay, assuming there is no intervention by the Bank of Japan. Weekly time frame, we are definitely showing market is slowing down, okay, but it is still upwards revision for a bounce of 139.5. So this bounce here continue, although it is at a slower rate. People are getting cautious, not sure whether there will be any intervention as we see dollar yen rate climbs closer to 160. Okay, so there is a concern. While the fundamentals suggest that the strength in the dollar will eventually see the dollar yen rate above 162, speculators are very, very fearful that the Bank of Japan may actually intervene. Whether they will intervene or not remains an open question, but the market definitely is respectful of the fact that the last time the Bank of Japan intervened, it caused the market to sell off all the way to 139.5. Right, let's take a look at the other currencies. Dollar Canadian. Again, we are seeing across the board the dollar strength. Okay, this is the dollar strength as far as the dollar versus Canadian is concerned. Okay, Canadian dollars are actually very, very weak. Okay, now we are going back to test the 130, 147. Again, there's very good chance it will go beyond and close beyond this level. Immediate level is 148.15. Okay, this is based on the higher time frame of the monthly time frame. So by and large, we can see the dollar strength is very evident. Do not trade against the dollar, because the dollar strength right now is based on the idea that the Federal Reserve may not cut interest rates, at least in the first quarter of this year. Okay, so that should give the dollar a little bit of underpinning. Okay, nothing to see here. Let's see if there's any other currency rates. Perhaps Kiwi dollars, for those who are into Kiwi dollars, this is definitely a very weak market. The market right now is flirting with the low of last year at 55 cents. Okay, so the closing here is 55 cents, 55, 0.5550. Okay, so definitely on the lower end of this range. But in terms of closing price, if I show you the closing price, look at this closing prices compared to the last time the market flirted with 55 cents. This is the lowest closing price we have ever seen. Okay, so this is something to keep in mind. Okay, on a close basis, this is the weakest closing we have, okay, since the rebound started. So this should actually confirm what we already know. Dollar overall is very, very strong. So it will likely to continue in the days and weeks ahead. Any kind of pullback in the dollar may be presenting a buying opportunity. That's what I'm trying to say. As far as the commodities are concerned, let's take a look at gold. Gold market looks like it's coming back, but I do not believe this is sustainable. Yes, this is the highest closing we have seen over the last 3 months. The market top out at $2,790 per ounce. Okay, but I still believe that this corrective pattern here is not complete. What we may see here eventually over the next few weeks, we may see a pullback below the low that we see here. Okay, this low here is at $2,536.81 per ounce. Okay, I think this low will be revisited sometime in the next few weeks. So I am not going to buy this this rebound that we saw in gold market this week. Okay, so I think this is likely to be kept below the all-time high, like $2,790.09. Okay, so this could be presenting, if for those who are very adventurous, possibly a counter trend trade. Okay, so when we look into the daily time frame or the weekly time frame, let's start with the weekly. Oh, no, let's start with the daily. So the daily here suggests that this pullback here does not look complete. There is a possibility market will challenge this high at 2,726. Okay, $2,726 per ounce, or even as high as $2,735. If the market goes into this dark pink area, that will offer a relatively high reward, low risk trade setup. If the market ever goes into this bracket of prices between 2,735 or 2,736 all the way to the all-time high of 2,790, I think this area here offers a great area to actually trade counter trend, because I do believe this could probably end up like this. A, B, C. Okay, and if that's the case, a natural support will be at $2,430. This is at the edge of the green line. Okay, the green box here. So this will act as a natural support. So by and large, I suspect that this is going to be what is going to happen over the next few weeks. For those who are keen to do counter trend, this could present some kind of trading opportunity in the gold market. Now, silver has outperformed gold this week in terms of the gain that we saw in the silver market. Now, silver is by and large having a different structure. We can see that there's no all-time high in silver market. The silver high is at $49.51 per ounce, and the high traded so far last year was $34.85 per ounce. And although we have a higher closing compared to the week before, but it is basically an inside bar. This two bar setup is an inside bar. Okay, so it does not tell us a lot. Okay, there is a possibility the gain that we saw in silver could unravel in the weeks ahead. Now let's go into the daily time frame and take a look at the structure. So again, we have seen what looks like to be a three wave. There is a possibility this time the market rebound may not even take up $32 per ounce. Okay, so by and large, it could be a larger degree three wave, possibly targeting the $26 per ounce. Still, the long-term structure in the precious metal market is not broken. It is still very bullish. So like equity markets, I think any kind of pullback in precious metals may actually present buying opportunity for those who are going to hold long-term. Okay. For swing traders, for silver, I think somewhere between $26 per ounce will be a natural area, because the previous time the market actually managed to hold at $26 per ounce in the silver market. So aim for this level. If the market ever comes into this level, look out for buying opportunity. Although I would love to see prices as low as $22, but I doubt that can be the case. Okay, by and large, I think the environment in which you're operating, which is tension, geopolitical tension over all over the world, is unlikely to de-escalate. In fact, there is every reason to see an escalation. Okay, so that should actually be positive for precious metals, not so much on the inflation outlook. Although inflation outlook should definitely support higher precious metal prices, but I think the catalyst lies in the geopolitics. Okay. Now let's take a look at crude oil. Crude oil has done very, very well this past week. Okay, we can see over the longer term period. Okay, this could lead to acceleration. Okay, come April. So I think the low in oil market may be already in place at $64. This is referring to the WTI. So I think it's coming in from this blue area in the monthly time frame. It is quite significant. Okay, the price right now is $75.63 per barrel. The market appears to have found a bottom and is now beginning to resume its long-term bull market. Okay, so I am actually quite bullish on energy markets. When we look at how this thing is, of course, there is a possibility. On Friday, we have a big surge in the oil markets, and this for now, tentatively, we are looking at a three wave, possibly targeting this level here. This level here is 78, 75. Okay, so we could be possibly looking at a challenge of these levels. Okay, it's still very tentative, but I think there's a very good chance. Let me highlight this level here. So the structure here appears three wave for now. So once everything will depend on what happens between $77.92 per barrel to $78.75 per barrel. So anyway, between this bracket of prices, we want to see the reaction. If there's going to be any kind of cap or any kind of resistance, it should show up here. If the market punch through and close above $78.75, it will be the signal to me that the market has finally bottomed and a new trend is developing. Okay, so watch this. The other development that I mentioned at the beginning of the presentation is that Ukraine has stopped the transshipments of natural gas through their territory into Europe. So this is going to cause prices to escalate, especially for the European. So the European right now are scrambling to look for sources of energy. Since they have no access to Russian natural gas, they will have to buy the liquefied natural gas from the United States and Qatar. And like I said earlier on, the US energy producer will definitely be demanding their pound of flesh, okay, because the market condition has created an artificial demand for the European. They have no other alternative since they have shot themselves in the foot by sanctioning Russia and denying themselves access to cheap energy prices. Okay, so overall bullish for crude oil right now. Okay, gold and silver may continue to correct. In the immediate term, I think the focus if you are into commodities is either energy prices or in the soft commodity. Today we don't talk about soft commodity because this platform do not offer access to soft commodity. The market has been looking at coffee and cocoa, and the fundamental is that China has locked up all the available supplies. Okay, China has gone directly to the source, to the producer, and lock in the supply. Now, as far as cocoa prices is concerned, China has locked in 40% of all global supplies. So that is causing the European chocolate makers scrambling to look for alternate sources. So that has been a quite dramatic. If you have a chance to look at coffee or cocoa prices, you will notice that those prices has gone parabolic. Okay, and that is has been a power play by the Chinese by building infrastructure for the producers in Western Africa, especially Ghana and the Ivory Coast. As far as cocoa is concerned, that allow the producers to actually do a lot of processing onshore instead of allowing the European to process those raw materials. Okay. Now let's take a look at crypto. Bitcoin is in corrective mode right now, continue to correct. Now remember, at the end of December, we have this pin bar in the Bitcoin. The high of 108,000 has been the high. There was a rally attempt at the beginning of the week itself, but now the market has come back down again. So this is not a good development. Technically speaking, we should be seeing lower prices. I have mentioned that we can expect Bitcoin to actually correct all the way to March. Okay, and if that's the case, that could be presenting a buying opportunity that would actually cause the bull market to extend even higher, because this move here is so impulsive. Okay, so that is the underlying. Over the longer period of time, I think digital assets should continue to rise. Not so much as for me to speculate on digital currencies, but I think technically speaking, it does looks like this market has no reason to collapse. Okay, it is a long-term buying opportunity. The structure of the chart does suggest uh, as such. Okay, so when we look at the weekly time frame, we can see that Bitcoin prices has been stabilized above 90,000. Okay, but I think by and large, we could see further correction all the way into March itself. So for the month of January and February, continue to see lower prices. If there's going to be any rebound, I doubt seriously the market will take up the all-time high so far at $108,345 per coin. Okay, and that is also seen across the other coin as well. Let's take a look at Ethereum. Ethereum is struggling for sure. It's not as bullish looking as Bitcoin, okay? But the market now is pulling back. So near term, I just expect possibly a deeper correction, perhaps to revisit the $1,000 per coin in Ethereum. So if that's the case, I think it's a buying opportunity, okay? In the weekly time frame, we are only seeing the beginning of this corrective pattern. It is a corrective pattern within a very strong bullish pattern here. Okay, so by and large, it's lower to buy. In the meantime, I think we should expect some kind of softer prices over the next few weeks. The other coins that actually is I'm very interested in is this one. Despite all the other pullback in the other coins, the one that actually managed to hold up relatively well is Ripple coin. Okay, now Ripple coin, if you do not know the story, the SEC, which is the U.S. Security Commission, the guy running it, Gensler, is going to resign on the day where Trump is going to be in about a week's time. Okay, so he has been anti digital crypto basically, and with his resignation, there is the possibility there will be, for the first time in US history, most of the Trump administration seems to be very pro crypto. So this will actually be a good year for crypto markets in the States, because for the first time we are beginning to get more and more personality in the Trump administration that favors Bitcoin. Okay, and that should actually be positive. Now Ripple is interesting because Ripple has recently launched what we call the RLUSD, which is another stable coin, just at the same time where Tether, which is the USDT, is banned in Europe. So with now in the stable coin space, Tether, which is USDT, and USDC, which is Circle, are the two dominant stable coin. Okay, now with the leader in the stable coin being banned in Europe, I think Ripple, the new USD is going to be eating up into Tether space, and this is actually underpinning this particular coin. Moreover, okay, we are beginning to see more and more banks using the Ripple ledger, okay, for payment. They are very efficient, very, what you call that, uh, less friction. Okay, meaning to say that in terms of the processing of payments by banks, a lot of banks, especially Japanese banks, are using the Ripple blockchain. So this will actually be very favorable to this coin here. Okay, so all things considered, I think among the coins, I am very, very excited about this one because it has actual use cases. Bitcoin does not have use cases, but I think Ripple is a different animal altogether. So if there's going to be a pullback I think this is going to be quite ideal. If we're going to see overall Bitcoin is going to be going to a correction phase, ideally it result in lower prices in Ripple, then this could be one coin that I will be very interested in. Okay, this is just my 2 cents worth. You do your own research, get to know a bit more about what's happening in the Ripple space here. I think it is creating a condition for higher prices, much, much higher prices. Okay. So is there any other thing that you want me to talk about? Oh, there are a couple of questions here. Let me see. I missed the question here. Uh, okay. Okay. No other questions? Anything else? Now, in 2 weeks' time, on actually 2 weeks, 2 Wednesday from now, I'll be giving a talk to a bunch of private investors at a private club in Singapore. I'm not sure you can get involved, but if you have anybody who is involved in tunnel clubs, every Tuesday morning they have a gathering, and this time I'm invited to give a talk there. So if you know somebody who have access to that and you want to come along, just know that I'll be presenting on the morning of January 21st, okay, at Tunnels Club in Singapore. Okay, if there's no other question, I thank you for your time and I shall see you next Sunday. Bye bye. Take care.